So, welcome to the April edition of Business as Unusual. And we are going to talk about supercharging growth by maximizing customer lifetime value. Our guest today is Chris Arndt. And we are so pleased to have you all join us on the streaming platforms. We are trying something a little bit new today, so please bear with us. We'll hopefully will not have a lot of technical difficulties. But we wanted to let you know that we will be welcoming your questions, so feel free to add them to the chat. Dana on our team will be standing by to moderate the chat, and we're going to get going. So Chris, welcome. I'm going to give your bio. So Chris is the entrepreneurial CFO. He's also known as Obra's Cloud CFO Services Director. Chris brings more than 15 years of experience in accounting of finance and wealth management fields. He specializes in financial statement analysis, system implementation, dashboard design, business process improvement, and forecasting. But still having the idea or the ability to see the forest through the trees. Chris makes sure that he anticipates and serves his clients' needs by harnessing the latest technology and sharing his accounting expertise with his clients to ensure the growth of the bottom line. But just as important, he also enjoys teaching, challenging his team and others to continue their own learning so they are able to grow professionally. Welcome, Chris. I'd love to kind of kick things off by having you just tell us what's not on your bio. Can you share some things about your career journey and your personal?
Sure. Thank you, Kathy. And thanks for the introduction and for having me here. And looks like that was quite the mouthful that you had to read there on the bio. So thanks for doing that. We didn't make your job easy. So some things that aren't on my bio. A little bit about me. I'm a recovering accountant, kind of turned entrepreneur. So I'm a CPA, started out in that normal kind of boring path in my career, and then I turned entrepreneur and founded the precursor company to where I work at now, which is Orba Cloud CFO Services. Started that company 11 years ago, and as an entrepreneur scaling a business, guess whose accounting was always done last? That was ours. So I've walked, in the same shoes as many entrepreneurs, understand that. So, when my team and myself, when we're working with our clients, we provide outsourced accounting and CFO services to middle market companies. When we work with them, I'm able to kind of speak to that entrepreneurial journey that a lot of our clients have. Well, I think accounting is boring, though. The financial insight you can get from it's awesome. And kind of related to the word awesome, just know I use that word a lot in everything. Awesome. And so you've been warned. I'm apologizing now. So when it gets thrown out maybe 10 to 100 times in the next hour, you've been warned. What else is in my bio? Let's see. I'm a complete data nerd and love computer programming and automating things, building great spreadsheets, and proud dad moment. I've got two boys. My oldest is 8. He just recently started really loving Google Sheets and doing some scratch coding. So as a proud data nerd myself, I love seeing that in my son. So there's a few things about me.
That is so cool. And I also like to use the word awesome. So we're just going to have to really amp things up today so we can really deliver on the awesomeness. So we always kind of like to start our conversations really around the growth lanes. And I'm so excited to talk about this topic today because customer lifetime value is really a form of organic growth. Most businesses get so excited about new customer logos and I find that it's much more challenging sometimes to get them to think about retention and how to use those metrics. So I'm really, really thrilled to be able to dig in today on that topic. So let's kick things off by, having you just sort of start big picture with, just helping us better understand what is customer lifetime value. It's often overlooked, but what would you describe it as?
Sure. And Parker, if you wouldn't mind going, so on this screen here, as far as the growth lanes, Kathy, as you touched on, we're definitely that top left quadrant. Acquisition is really, I think, what we're targeting here. And then if Parker, you want to jump to the next slide as well. We've got some scary formulas here that don't worry, we won't bore you with those. But high level, customer lifetime value is how much profit do you make from a customer over the time from when you sign them as a new customer to when ultimately you lose them for whatever reason. You kind of there's a calculation we can talk about going in there, but that's the very high level, is what do you profit over a period of time while having that customer.
And then also on the screen is, CAC, another term that gets thrown out, like customer acquisition cost. And at a high level, describe what that means?
Yep. And again, as a high level, without getting into the actual formula yet, high level for CAC, customer acquisition cost, is what do you on average spend to acquire a new customer? So there's different costs that go into that, whether it's salespeople, online marketing, offline marketing, content, the cost to create content. A lot of costs go in there. It's sort of, you average it out over how many customers you bring in over a period of time. So that helps you understand, what are you investing in a customer relationship, and then when you put the two together, you're hoping that investment in a customer relationship over time yields a much larger customer lifetime value, which is the profit you get back.
So, before we step deeper into the calculations, what are, what's your experience with customers and having a savviness or, leveraging these data points in their business? We are not finding that a lot of our clients or prospects are really paying attention to these numbers specifically. Is that, why aren't people more interested in these variables and data points in their KPIs?
Yeah, I think from what I've seen, companies that are backed by professional investors, so private equity firms or venture capital, I think they typically are tracking these metrics because by design, their investors are investing in them with the hope that they're growing and the expectation that they're growing the business. And that's what these professional investors want to see. And they know that these two metrics, which are very much correlated, and you will talk a lot about how one by itself doesn't mean a lot, but together it makes sense. They know that if you're trying to grow and scale a business, these are probably the most important metrics to track. Now, as far as other companies that maybe aren't backed by professional investors, I think from what I've seen, these businesses have grown. The founders, the owners, the CEOs, they know they want to grow, but you get caught up in life, and there's fire drills, and you're always trying to put the next one out. And I mentioned earlier how when I was growing and scaling my company, I didn't even do my own accounting, much less track metrics like this. So I get that it's easy to kind of put it on the back burner, but it's it's something that every business should track and can be very important. And I think what I've seen is, I think that most people, the risk here of not tracking these metrics is that maybe you're overspending to acquire customers. So if you're if your customer acquisition, your CAC is too high versus your lifetime value, that's a good way to grow yourself broke, and that's not awesome. But I had to throw that in, right? But what I think the biggest risk of not knowing these numbers is actually the complete opposite. I think in general, a lot of businesses maybe that are maybe not running on as much data and numbers as they should, they're running from the gut. I think they underspend on customer acquisition, and then they wonder why they're not growing as much as they could be. So I think that's the real risk, actually, is underspending on your acquisition costs, not realizing that your lifetime value of a customer is so high, and that you could actually spend and be more aggressive to acquire them.
Wow. I mean, I really, well, obviously my business is based on helping people acquire customers. So I love the idea of being able to help them think about spending more on that first acquisition cost. But no, I mean, I think these are important metrics, and I don't think it's as complex as people might make it out to be. And with any metric, it always is like, you got to start somewhere. So, how do you start benchmarking out of the gate, and then being able to really improve on your understanding of these insights over time. So let's jump in and have you sort of talk us through sort of customer lifetime value. How are you getting to that that payback period, better understanding the model itself?
Sure. And Parker, if you wouldn't mind backing up one slide, just we'll touch on that a little bit more, then I'll have you go for it. Thanks. So let's take that first little blue box there, which is the formula, again, scary formula for CAC. Really, I'm just going to boil it down. It's what do you spend in total on your sales and marketing costs that you spend to try to bring in business, divided by how many new customers do you bring in during a period. Now, I think per month is a good time period to track this on, but you could, for whatever reason, if you said month doesn't make sense, you could look at your spend on these things over a quarter and divide number of customers added in a new quarter, and it works just as well. Then you just want to align the same time period of what your spend is versus how many customers I added, and that works. So if you spend $100,000 in a month on your sales and marketing, and you bring on two customers, your CAC is $50,000 per customer. Now you better have a pretty high paying customer for something like that. Different businesses have different metrics there. It's not a one size fits all. It very much depends on your business, and we'll talk a little bit more about that later. So that's customer acquisition costs. It's costs bringing on a customer. It does not talk about anything related to the life of the customer, or how long they've been around, how long are they with you, or customer service or account management costs related to keeping them. You don't include that. It is purely the cost to go and acquire the customers. So that's CAC. The other key formula here, which again is very much linked, is your customer lifetime value, LTV, CLTV. It's abbreviated different ways. This formula specifically is targeted towards a SaaS, like a subscription type business, but it very much correlates to a product as well. So let me touch on that. I'm going to speak to how it's worded here for SaaS, and then I'll kind of correlate it for you. So to figure out a lifetime value for a customer, you're going to take what is the revenue, usually a monthly period, that monthly recurring revenue, again, your subscription business in this case, what's your monthly recurring revenue for your customer, times by your gross profit percentage. So how much of that do you actually keep then as profit for that customer? And you're simply you're going to multiply that by how many months on average your customers stick around. And that's the high level. How much profit per month do you make off of them? How long do they stick around? Multiply it out. That's your lifetime value. Now, there's some nuances that go into that. Figuring out your gross profit margin. This is where you do factor in your ongoing costs of keeping your customer happy. So if you've got customer service, or if this is again SaaS and you've got ongoing like server platform costs, those costs it takes to serve an additional customer, those are the things you back out of the revenue to kind of arrive at a profit. Now, if you're a traditional SaaS business, you usually have very little incremental costs for a software subscriber, so your margins are usually very, very high. And then again, you multiply that by the lifetime, the number of months those customers stick around. Now, this is probably the trickier thing to try to identify. Is, well, you're like, how do I know how long my customers stick around on average? Because you can pinpoint customer A who loves you and has been with you for 10 years, and then you've got customer B that signed up 2 months ago and churned out. So how do you account for that? Well, that's where you have to understand what your churn rate is, which then you use to imply the number of months they're around. So using my business as an example, and I'll use it as an example later on as well. I like to joke we provide accounting as a service. So our clients sign on and they pay for our service. It's like a subscription. They pay us every month, flat fee for our services. So to figure out churn, I'll look, over like a quarter of the year or even a full year. Sometimes we usually have longer client lifetimes, so I can look at this over a year, and that's a more stable number. But I'll look back over the last year. You look at how many clients did I start the year with? Let's say you started the year with 100 clients. And then during the year, you lost 5. Well, that implies 5 over 100, 5% churn for a year. And you just use the inverse. I know we're getting all like nerdy stuff. I can whip out a spreadsheet if you want, but because I love those. But if it's a 5% churn, you would take, what is it? You take 1 divided by 5%, which equates to 20 months on average lifetime. So about a 2-year lifetime. So that's how you figure out this last piece of that formula for customer lifetime value. So that's the high level for a SaaS business. Any questions there before I kind of give you a parallel on a product business?
No, I think you're going to touch on it later on, but I definitely was curious about some of the right sizing your customer acquisition cost. But I in terms of like to your point, if it's costing you $100,000 to acquire 2, really is there some metrics to match up? And I think you're going to dive into those.
We absolutely will. Yes, very next thing right after this. So good segue. Awesome segue. So using lifetime value for a product business, let's say, you can take what's your average sale, like check size, order cart size, whatever you want to call it, per order, times it by your average gross profit margin that you have on those products after fulfilled. And that correlates to, on this current formula here, the monthly revenue times gross profit. So you're figuring out how much profit do I make per order in this case. And then then for the lifetime value or how many months, you're actually trying to figure out not how many months, but how many orders are you going to have over the lifetime of that customer. So average profit per order times orders in a lifetime, that's the correlation here. Very similar formula for that.
So in terms of most service businesses then, Chris, if you're going back to sort of that SaaS model, do you really kind of also look at service businesses in the same way of, with lifetime value as a software as a service type business typically?
Yeah, so if it's a service business, I guess, are you maybe thinking not like mine where it's recurring every month, but maybe like you're doing a big project for somebody? Is that what you mean?
No, I mean, I am thinking recurring every month, but it could be project-based as well. So it
Yeah.
seems more in line with that first model than the second.
Yeah, if it's a service business where, your clients, it's like a retainer every month or something ongoing, yeah, you are exactly like a SaaS business. Now, if you're a service business and you're doing kind of one-off projects as needed, then you fall closer. You're really more like a product business. It's
Okay.
now you're looking at per order or project. How much do you make per project? How many projects do you think you'll do in a lifetime with that client?
Fantastic. And would there be a nuance if you were doing multiple projects in a year with the same client, or would that you look at that differently?
Yeah, good question. So if you're doing multiple clients in a year, then it's simply you're having more orders in a year with that client. So theoretically, the more projects you're doing with somebody, the more frequent it is. You should have a higher lifetime value then on average with those clients because you're able to work with them more instead of just a one-off project. So that's doing multiple projects. Those are ways to kind of increase your customer lifetime value, and we'll talk later about more things on how do you actually increase that customer lifetime value.
So, I mean, but I think, to suffice it to say is that no matter what business you're in, these formulas really work across all sectors. But you may fall more into that at software as a service or service-based model versus that one-off sales type model. But every type of business should have a way to track this metric.
Absolutely. Yep. And even if you're, uh, not growing your business as much, you should still track it. You should understand the metrics. I guess I'd ask, why don't you want to grow your business? Would be another conversation for another day as well. But yeah, these are important things that every business in any industry really it relates.
Great. So I know we're going to move on to sort of getting to the next slide in terms of how are you looking at that payback period?
Yes. All right. So Parker, yep, you're there. Thank you. So this is an illustration that puts together what we've just been discussing so far. So the vertical line with the dollar sign, that's right where it crosses. That's like day one. There's a little dot there. It says customer acquired. So you see you're actually starting negative, in the negative for dollars there because you've spent money. It's out the door. You spent it on salespeople or content or advertising. So when you start day one with a customer, you're negative with them from an overall standpoint. Then as they order from you or you provide services, you generally start making some money back and make it back. And at some point you get to the point where you break even, where you've recovered those initial acquisition costs. That's your break even point, your payback period. If you think about a high level, the faster your payback period, the better. The faster you can recoup that money means the faster you get to a profitable lifetime value with that customer. So always trying to do things to reduce payback period is great. And then the right side, the blue side, that's your profit of holding on to the customer over their lifetime. And that horizontal line is called time. So the longer they stick with you, the more blue you have, the more profit you're gonna get from them. And that's what we're trying to do as far as maximizing lifetime value is having them stick around longer is one way to make the blue more. That means you're lowering your churn. Or if you can increase the slope of that profit line and grow it faster, then you can make more profit too. And that there's ways to do that by upselling, cross-selling, which we'll talk about a little bit later as well. So let's see. What is I
So
gonna...
Chris, really quick before you move on, I in terms of just really clarifying for attendees that customers acquired, really you're baking in the customers you're not acquiring into that like front-loaded expense area. So we're not all, though we probably like to be closing at 100%, there are some people that are not going to choose us, and just so we're all clear that customer acquisition pre-period is baking in people that you're not winning.
Yeah, absolutely. Good point for sure. These are your total sales and marketing costs during a period of time over the customers you acquire. So it's an average cost. It is not just specifically to the customers you bring on. So yeah, very good point.
Yeah, and so in terms of CAC reduction, like improving close ratios, all of those things, getting more clear on, better clients, and matching up where you're spending time in acquiring clients are key important things that we'll touch on. And as all right, so moving on. So what are some of the things that we can do to to sort of step into improving our customer acquisition costs?
Yeah. So actually, Parker, would you back up one? Thank you. So actually, before we go and talk about how to improve them, I think it is important. We've talked maybe a bit about you're investing some money and you're hoping to get a lot of money back later on the customer, but we didn't really talk about is what's a good ratio for that. So if we talk about what an ideal ratio is, then we can talk about how do you find out where you're at now, and then how can you pull those levers to get maybe to an ideal ratio. So kind of the magic ratio is a 3-to-1 ratio. So for every $1 you spend on your customer acquisition cost, you're hoping to get $3 back over their lifetime. And that works across industries. And as businesses are different, SaaS, versus product, even, a nonprofit business, you're acquiring donors, right? Like that
Right.
same kind of concept. So 3-to-1 works in pretty much all of those cases, because those metrics factor in what are your gross margins and your cost of acquisition. Like it factors in all the key variables. So it actually is a consistent number you can use across the board. And this is where I said earlier that I think the biggest risk is companies not spending enough. This is where you can start thinking about that. If you know your ratio is 3 that you want to be at, if you can identify what is your customer lifetime value on average, and start out, if you start out just do simple back of the envelope type calculations to come up with these. Something's better than nothing. If you know what your lifetime value is, then you figure that out. You can divide it by 3 and know how much you can spend on acquiring business. So I'll use an example with our business again, just to kind of illustrate this. We have an average monthly revenue of $5,000 a month with our clients. Let's call it I'll use some round numbers here and get us to nice easy numbers to work with. If we have like a 40% gross profit margin, that means we profit $2,000 every month from our average client. We have about a 4-year life, with our clients on average. So let's just call it 50 months for easy math. So $2,000 a month for profit times 50 months, that equals $100,000 is the lifetime value for one client for us, which is a fairly substantial number. Divide that by 3. I can spend $33,000 to acquire one of these average clients, and it works out, and I can grow. I can tell you, I know this in my head. I don't spend anywhere near $33,000 per client. I'm probably closer to $10,000. And we have other bottlenecks in our business right now. We're growing fast, and I don't think pouring more fuel on this CAC fire would make sense for our business currently. But at least I know it in my head. Like I know I could spend more if we were fully set up to be able to handle all that work. I could spend more on it. So just knowing that is a nice thing. So that's that play, and that's why these two, knowing that my lifetime value is $100,000 without knowing what I'm spending on them is useless. Or knowing that I spend $10,000 to acquire a client without knowing a lifetime value, it's useless. The two together and that ratio is really what matters.
Yeah, and I love that. I do, want to ask a nuanced question, because a lot of our clients, or not all of them, but many are in manufacturing, and many have had, really long-standing businesses, 50 years, or some in construction. When you've and they frankly have, maybe maintained somebody for 20 years in terms of a client relationship. When you're starting to get into those long-term client relationships where maybe even the business has been acquired or what have you, do you still use those kind of outlier data points in modeling this type of thing, when there's, you could have just a handful of really, really long-standing relationships?
Yeah, great question. So far, everything we've been talking about is high level for the overall business. What are your overall metrics? Which is a great starting point, but it doesn't help you necessarily identify what customers should you be targeting when you're trying to spend your acquisition dollars. And that's where you actually want to segment your business into different things. And Parker, if you wouldn't mind, we can jump ahead. The next one, we don't really have to spend too much time there, but the segment for success, go forward one, please, to the graph. There we go. We don't need to look at all those numbers on the last chart. That's just me getting all excited about spreadsheets again. So this is where you can segment for success, which is awesome. You can break down your CAC and your lifetime value into different subgroups of customers, and you can slice and dice in different ways, but you can break it down to identify maybe certain pockets of customers that are more valuable to you. So if you got that, that customer that's been around for 20 years, maybe you've got a handful of them. Now, if it's one by themselves and they're a complete outlier, it's nice to have. Maybe you can't do a whole lot with that. But if all of a sudden you've got this like, group of customers, and they all have, similar characteristics, and things you can be looking at are, what's the size of the business? Where are they located? You can also do, what industry are they in? Or maybe what sales channel, how did you acquire them originally? Like, where did they come from? Because that could help determine. So, if you acquired a customer because they found you via SEO online and they found some content and they really liked what you were putting out there, that's potentially a different feel for a customer than one that, clicked on an ad, and found you via an ad. Like, great, both could be great customers, but they may turn out to be very different for you. So again, this is just different ways you can slice and dice your clients and your customers, and figure out if you can make subgroups, and you can say, okay, let's use what's on the screen here. This is an example of like a SaaS business, right? Like they're breaking down, maybe they have different offerings, and they have, like, let's use Dropbox as an example. They have a personal product that they sell very cheaply, or even free. They've got a standard, which they charge a little bit more. Pro is more, and then enterprise is like custom pricing for bigger companies. Breaking their business down into these segments, they can now look at, what is my cost to acquire a personal user versus my cost to acquire an enterprise company, and that's the blue chart on here. And typically takes a lot more cost to land a bigger client like enterprise. And then you can also look, once you start breaking down your customers and segment it, what's my lifetime value of a personal user versus enterprise? And here you're going to generally see, again, similar, where personal, you probably don't, they churn out a lot. Maybe you don't charge them much. You don't get a lot, depending on your business. Whereas enterprise, it takes a long time to land them, a lot of sales costs. But once you do, they have high switching costs. They're going to stick with you a long time and have a very high lifetime value. And then the other types are sort of in between there. And so this is where you can maybe decide, who am I going to go after? So the blue bar here is the CAC for each segment. The green bar is the lifetime value. The number with the red line, that's your magic ratio. And what you can see here is actually one of the most efficient uses of your capital right now is in the pro. So even though pro has a lower lifetime value, total lifetime value versus enterprise, they cost less to acquire, and you're getting a ratio of 5 to 1 on them. So maybe, you know what, if you have to pick what you're going to focus your next level of growth on, focus on pro. Invest dollars to acquire more pro customers, and you can spend more because your ratio is even higher than it should be. Then if you go and attack that segment, then eventually the cost to acquire more pro clients will go up, and that ratio will come down maybe to that 3 mark where is ideal for you. Then once you're there, you're a larger company, now invest in the resources and going after enterprise. So again, every company is capital constrained. If you're doing everything, you're doing nothing. So this lets you segment and decide where you're going to focus your acquisition dollars.
Yeah, I mean, I love this, you know, and I do think it's super important. We definitely talk about it a lot of times, really anecdotally around, you know, letting sort of automation and digital things go after those low, like, you know, lower return opportunities, like is shown in this model, personal or standard, and then really get people involved as you get towards that pro or enterprise type of client. So, and then I also, you know, I think you sometimes see the trends where you've got all of your eggs in one customer basket, and you know, really need to diversify overall who your customer base is, because you're really sort of skewed towards, you know, a couple of customers, and if you lost one, that would be really, really challenging. So, you know, even thinking about that kind of data point, trying, you know, they always say the 80-20 rule, but I do feel like we all get caught up in you know, our bigger clients, and it's really tough to make sure that we're making the right decisions around what segment of the business we should be going after.
Yeah, and you'd asked earlier, you know, before we started talking about the magic ratio, you had sort of asked, like, well, how do we increase our levers? Like, how do we improve you know, customer lifetime value, or improve the profitability of customers? So this is one of the things that we're talking about here is segmenting your business and targeting certain segments that either have a lower CAC to the lifetime value of them, you know, so just basically being thoughtful of where you're allocating your dollars. That ultimately, by focusing on a higher ratio segment, you're getting a better bang for your buck for growth dollars, and so that's one of the ways, and you know, we kind of call that profile your best customers when you're doing that, or at least profile who your best customers are to go after right now, would maybe be a better way to say that.
And I think you also had some other ideas around how to improve some of those retention, or sort of those, you know, where you're going to retain people and create some more profitability as well, besides just profiling.
Yeah, that's right. If Parker, you want to jump to the next slide, this is another way. We won't stick on this one too long, but this is another way to maybe identify potential problems with your product offering, or maybe not a good fit for your customers. And so this is sort of a quick look at a cohort analysis. So instead of looking at all your customers in one basket, you're segmenting them in a different way now. So in the last slide, we were segmenting them by, you know, industry or size. Now this one, we're breaking out the customers we're acquiring from different periods. Now this is, you know, probably more relevant if you're doing a business, you know, more of a SaaS type business, or Well, SaaS or a higher frequency like product sale business where maybe each purchase isn't big by itself, but you expect a recurring frequency of orders. So you expect some, ongoing frequent orders or projects. You can break them out into cohorts. So what customers did you sign up in month 1 versus what customers did you sign up in 2 and 3 and 4, and look at them as their own cohort, just like when you go to college and you're a freshman or a sophomore or junior, senior, same concepts. So in this top slide, if this is a company that's growing a ton, they added 100 customers in month 1, line 2 they added 500 in month 2, in 3 they added 1,000, then 2,000. So they're growing at an accelerating rate. And we're not looking at all the numbers here, but when they looked at just an overall churn percentage, because they were growing so fast, their overall churn was only 5% a month, which for their business wasn't alarming at all. They're like, yeah, we expect them to stick around 2 years. That's about right. But when you broke it out, you find things that the high growth was masking. And if you look at that on the bottom table, month 1, where it's highlighted yellow, all of a sudden you see that first cohort they're sticking around the first 3 months, and then they start dropping like flies in month 4, 5, and 6. By 6 months in, you've only retained 40% of your customers from that initial. So that by breaking them into cohorts, you never would have found this quickly if you're 6 months in and the business is growing that fast. You think everything's happy and glory and awesome. But in this case, you're seeing that, hey, something happens after the first 3 months and our customers aren't sticking around. So, maybe you're one of those meal subscription services that provide prepackaged meals, and your customers sign on and they love your food for a few months, and then you're not changing things up enough, and they get bored of your offering, and then they start churning out quickly. This could help you identify that. And so the key here with cohort is it helps you understand your churn, which, if you look back at what are our calculations here, a higher churn means a lower customer lifetime value, and that's not what you're trying to do. So this type of analysis can really help you understand churn and maybe figure out what's going on.
Yeah, that's an interesting model. In this case where there's potentially like a larger upfront investment for the first year, and then to the renewal cost, or I don't know if that was the case in this month-over-month situation, but how do you factor something in where it's like graded like that, where say you spend $2,000 the first year, and then it's reduced down to $300 or $400 in the second year, but you're seeing drop off on that retained, renewal group of clients.
So you're saying the renewal is that lower price that they pay?
Yeah, like you've got that kind of price differentiation. Is that something you'd look at differently?
Yeah, potentially. I mean, if your renewal fee is much lower than the initial, then if you think about it, like initially they wanted to pay you more, right? They paid you more up front, and they saw or they thought there was going to be value there. And now the renewal, which ends up, in this case, if you're pricing it lower and they're still churning out, there's something going on. Like you're not delivering on whatever they thought they were getting. Their expectations versus what you're giving are off. And so churn coupled with knowing like what you're charging can be very useful.
Yeah. There's a couple of clients I can think of that, really do have to look at those types of fall off. So what are some other things that we can do to, improve profitability and retention?
Sure. And Parker, if you want to jump to the next slide, we'll just get off some of these numbers. That way we're not staring at those numbers too much. Thank you. So other things we can do. So we talked about sort of targeting, maybe the profiling the best customers. We talked about that and ways you can do that. Other things you can do to increase the lifetime value of customers, you could cross-sell or upsell to them. So what's something to do? If you're an e-commerce business, one thing that Amazon's amazing at is stuffing in front of you. Hey, other people want, like you bought this, or maybe the Alexa's listening to you, and magically in your, when you're on Amazon next, you see exactly what you were talking about. So it's scary, but yeah, these recommendations, or when you're about to check out and they say, hey, how about add this, these upsells, those are things that ultimately increase your average order size, which by definition increases your lifetime value for the customer. So you can do like something like that. Similar, if you're like a service business, maybe you have a good, better, best offering, and nobody wants, if there's the best offering out there, people want the best, right? So dangle that shiny object out there and start them, they'll come to you looking for the middle or the low, and show them what they're missing out on, so to try to upsell. Those are ways, or provide another service. So the company I founded 11 years ago, I sold it to Orba 6 years back, and I still run the group. Why did they acquire us? We're very complementary. So their firm focuses on tax and audit services. We provide outsourced accounting. Every one of our clients also needs to have their tax return done for their business. So there's a lot of complementary, and we try to cross-sell and sort of land in it with the client and expand our services. That's how, as a firm, we can expand the total lifetime value of that client by providing other services to them.
Yeah, no, I think that's great. And, and it doesn't even have to always be as formal as being acquired. There's a lot of opportunity for strategic partnerships to add more value to customers. Obviously, when you offer a lot, I think sometimes people just only think of you in that one way. And so being able to, remind them that there are other ways they can leverage your business. So any other thoughts there on, growth and profitability?
Yeah, so we'd already touched on sort of reducing churn with Cohort, which ultimately gives you a longer lifetime value. I think the last one, touch on quickly, and then we can wrap this up here, is referral programs, like customer referral programs. I think these are kind of interesting because they can actually lower your cost of acquisition to get on new customers, also increase your lifetime value of your existing customers. So it's kind of a double win. Lower one, raise the other. Is a good thing. So how does it do that? I'll use my gym membership, which let's pretend I go there often, but I have the membership, and they have a referral program. If I refer in a new member to the gym, they'll give me like a free month of membership, or they'll give me some free personal training sessions. And the more I bring in, the more valuable it is, right? So to them, I don't pay them 1 month of a gym membership. Big deal, and they just got a whole new member that's going to start paying them every month now. That's a low cost of acquisition. They don't have to pay anyone. They don't have to advertise. They're just giving me a free month, which to them there's almost no cost in that to a gym membership. So that's how they can lower their cost of acquisition, and that's lowering cost of acquisition for their new member. Now the flip side, me, if I'm bringing them members, maybe, they kind of roll out the red carpet. Now they're making me feel like a VIP, or like now they know my name at the gym, and they're like, hey, Chris, how's it going? Haven't seen you in a while, which is probably the more common statement. And or because I'm getting incentives and free membership, I'm going to stick around. It's costing me less. It's like a win-win. So that's where a referral program can actually make me stick around longer lifetime value, and cost them less to acquire other members. So that's where referral can do both and move both levers for you.
Yeah. And I think, like a lot of B2B businesses could use things like advocacy, really getting either customers or employees to share out content on social channels about their experiences testimonials, so that you're, it's not as maybe as easy as a referral program. And I know we've tried to sort of think about those experiences and how they could work in the B2B space, but not as easy. But I do think, those advocacy programs and having, endorsements and testimonials speak to a very similar situation where somebody would recommend you as well. So I'm gonna love to kind of turn it to see if we've got any questions from our audience, but I do want to ask, as we're sort of getting those questions in, Chris, where do you start? Like this, there's a lot of data points here. There, where if you were sort of starting off with a client, or saying, this would be the right starting point. What would you say would be kind of a first step?
If we were, sorry, can you say that one more time, please?
Yeah, I mean, so if a business hasn't been tracking these types of metrics in the past, and it might feel pretty lofty. I know a lot of clients don't even have some of those financial data points to look to. Where would you recommend somebody just starts?
Yeah, I think for me, I would start trying to figure out lifetime value, because that is currently what a customer is worth to you. And just go off of easy numbers. Look at all of last year. Like, you're probably, you're at least, hopefully getting accounting done on a yearly basis, and you have financials. Now's a good time to look back at 2021 and total up, just, take out your P&L and total up all your sales and marketing costs. Just highlight them, add it up. You get a total number. Don't worry about being perfect, just total it up, and then look back and say, how many new customers did we add last year? And divide that total spend, divide by those customers, and you've got your starting point for a lifetime value. That's a great starting point. Now, from there, if you divide that by 3, sorry, that's your customer acquisition cost. Sorry, I mixed it up. So you can see what your customer acquisition cost is. Now, for lifetime value, look back over the year and see how many customers did we lose. And again, this can be, just do it on paper. Like, you don't need spreadsheets. You don't have to geek out like I do. Write it down. How many did we lose versus how many did we start? How many did you start the year with? That's your churn rate, and that lets you just figure out how long they stick around, and then you can come up with, on average, what they spend. So it's pretty, just from super high level, without worrying about segmenting. Don't do that. Don't start there. Just get those high level numbers that you can do on a piece of paper just by looking at your P&L from last year and knowing your customer count.
Well, I so much appreciate that, and I appreciate you being a guest today. It looks like we must have been so crystal clear, because we don't have a lot of questions from our attendees. But I do think you really did sort of simplify things, and I appreciate you sort of giving everyone that starting jumping off point. We have one question. What do you recommend we do if customers are not meeting lifetime value or quickly paying off with CAC?
Yeah, great question. So this means you've gotten to the point now, you've identified what your CAC is and your lifetime value, and you realize that, oh, we're not getting a 3-to-1 ratio, and maybe it's much worse. If it's less than 1, it means you actually lose money. So you're spending, $100 to acquire them, and you're only making $80 from them. The more customers you add, the faster you go broke in that case. So what do you recommend? What do you do? I mean, this is where the magic happens, and you have to know and really dig into your business. So all this number does is highlight to you have a problem. Now you need to look and figure out, like, is CAC too high? Is your lifetime value too low? Is it a combination? You could kind of benchmark your numbers against others in your industry, because that's something that can help as a starting point. If you can identify which of those numbers maybe is the worst offender, if your customer lifetime value is too low, then you probably have too high churn. So talk to your customers. Why aren't they sticking around, and why are they leaving? That would be something I'd go after there. If CAC is your problem, maybe you've got the wrong sales approach. If you're selling some small, $50 online orders, and you're using expensive salespeople with outbound sales, trying to drum up sales, and all you get is $50 an order, that doesn't work either. You have to change your acquisition strategy and lower that cost, if that's what you're doing. So it depends, I guess, is the answer.
Right. No, I love that though, but I do feel like even, there are a lot of transaction situations where they are low, but you're still spending quite a bit to get them. And we're even recommending, if you're not ready to go full e-commerce, do start to take the steps to get there. What else can you automate in that upfront process to, it's like a one-time cost to automate some of these things, with a lot that can pay off quite, well in the long run. But so, no, thank you so much. Well, I know people are probably going to think of a question after the fact. So, Parker, let's share how people can get in touch with Chris if they've got any further questions. And so, you can reach out to Chris via LinkedIn, connect with him on LinkedIn, or reach him directly via email. And just please be sure to put business as unusual in the subject line so he knows where your question is coming from, and he is willing to answer it quickly. So thank you so much, Chris. We really appreciated you being on today. I am going to tell you guys all about our next event coming up in May. We're really excited about that. So we want to kind of continue on this methodology in terms of thinking about, once you've started to identify maybe that you aren't investing enough in acquiring new customers and have some opportunities, what would you do if you had $1 million at hand and could, really think about how to invest that in your business? So we're going to be talking to Ami Kasser about innovative ways to fund your business growth. And Ami's the founder and CEO of Multi-Funding, and he's an author of the book, The Growth Dilemma. And he's really earned a national reputation as a thought leader in business finance. And so he's an in-demand speaker and trusted advisor to many business leaders, and, regularly featured in the New York Times, Huffington Post, the Wall Street Journal, and he does do a weekly column for Inc. magazine. So I attended one of his sessions. He's really exciting. He really thinks uniquely about some different funding opportunities. And so we are going to have a panel of business runners, and Ami's going to take us through some different methodologies and put some people on the hot seat to talk about what they do if they had a windfall of cash come into their business and what their risk tolerance would be around investment. So with that, I thank everyone for joining us today. Again, thank you, Chris. It was just a pleasure to see you again and have you as a guest on Business as Unusual. If you've got any questions for us at Red Caffeine, please reach out to connect@Red Caffeine, but we will look forward to seeing you all on the next Business as Unusual in May. Thanks, everyone.
Thanks, Kathy.